Eric Averill, and I'm joined by my partner, Brandon Averill. Today,
Disclaimer: Eric Averill and Brandon Averill are the co-founders of AWM Capital. Due to industry regulations, it's essential to explicitly state that investment or strategies mentioned on this podcast may not be suitable for you, and you should discuss your specific situation with a qualified, certified financial planner. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of AWM Capital or its affiliates. For more information, visit athleteceo.com.
hey everyone, welcome back to another episode of the Athlete CEO podcast. I'm excited for our show today. We've got a great interview that I'm convinced will very quickly become the most referenced podcast that we've done so far. And the main reason is this is going to be filled with practical information that every listener, whether you're a professional athlete or not, can take away, ultimately to help you feel very confident about the people that you're trusting to help you manage your finances. And so today we are joined by David Byrne, who is a certified fraud examiner and a certified anti-money laundering specialist. He is the founder of Lights LLC. David, thanks for being on the show.
Thanks for having me. Really appreciate it.
Yeah, you know, it's a fun topic to tackle. It's one of those things that you never hope happens to you personally, but it's a really real thing. Is we've experienced a lot of distrust within the financial industry, and consumers are really at the mercy of the people that they hire to manage their finances. And so I'm really excited to have you on, and I know that our audience is going to be able to walk away, from this conversation, not only with more information, but with a lot of resources that's going to be able to help them. So thanks again.
Yeah, can't wait to talk about it. I'm really, really excited to kind of let you know about what I'm doing with my business and let all the listeners know what's going on.
Yeah. So let's start there. Why don't you tell our listeners what exactly does Bright Lights do, and what is the mission that you guys are trying to accomplish?
Sure. So simply put, Bright Lights monitors professional athletes' finances to ensure that their financial advisors, business managers, and anybody else who's dealing with their finances doesn't commit fraud, and also has their best interests at heart when they're managing their money. The mission of Bright Lights is to end fraud in professional sports. And to go a little further with what Bright Lights does, it's kind of in two different buckets. Like I said, we monitor pro athletes' finances on a continuous basis. So we act kind of as an independent third party, overseeing their investment account statements, their bank account statements, other things that come up, other pertinent documents, and just make sure that everything that's going on is in line with what the customer is looking for. The other thing that we also do is what we call deep dive reviews, and they're kind of like audits. It can go from, if the athlete's 5 years into their pro life, it can be from 5 years on back to the beginning of when they started their investment accounts, their bank accounts. And we just do a deep dive in everything that's gone on to make sure that there's been no suspicious activity, that there's been no red flags, that the investments and the allocations are in line with what the customer's looking for, and a whole kind of host of other issues that we look for.
Yeah, that's fantastic. And I think, one of the analogies that I read on one of your articles was great, in the sense that you talked about the athlete thinking of themselves as their own corporation. Literally on our most recent podcast, I spent a lot of time talking to the athlete about acting as a business owner and, treating themselves as a business. And you're right, for us, we're the CFO that comes in and takes care of all of their finances. It's their agent that's helping them do their contract negotiation, and, they have an accountant and all these people, but one of the things they're missing is the compliance department. And I thought you just put that so brilliantly that, there's a lot of stake here. Is their focus is on the field, They've got an agent in place, they've got us as a financial group in place, but there really is nobody there doing the checks and balances. And so can you talk about the importance of that?
Yeah, it's funny because I think a lot of people don't particularly grow up with the understanding of even that a compliance department exists in finance. and I didn't really, when I started in the industry, I started at Merrill Lynch as a financial advisor, and I didn't really particularly know what a compliance department was. And you start to kind of understand, there's some people in these places who are supposed to be looking out for the customer, but then you kind of start realizing, well, this is also a for-profit corporation, and there's some, pushes and pulls there that kind of prevent them from doing their job. And, it's funny because this podcast is called Athlete CEO. And, you guys have the exact same kind of idea that I do, that athletes are the CEO of their entire organization. And one thing that I try to tell them is you have all these things in place and these people in place, but you don't really understand that there's no one really looking out for you on your financial side, outside of your financial advisor, who we all hope is going to do a really good job for you, but you do need some checks and balances there. And that's where kind of the compliance department comes in, and that's where Bright Lights comes in that sense.
Yeah, makes a lot of sense. So to put some, I guess, meat on the bone is talking about some specific client experiences or things that you're seeing. We had Chase Carlson on the podcast a few months ago, and he talked a lot about the big stories we hear in the news of, right? Of, Mark Sanchez and Jake Peavy and, the latest things going on with some of the former basketball players. But I think a lot of what you see is probably a little bit different than just the outright Ponzi scheme, scary stuff that a lot of the stuff you're seeing could probably go on forever underneath the hood of a financial advisor. And a client really never know because it's just not outright Ponzi scheme-ish. Can you share some of the things that you're seeing in the work that you're doing?
Yeah, I think that's a really great point. I mean, what I'm seeing is it's a number of things. For one, getting involved in this industry, I came in and started this business in a way because I understood the risk that athletes are at with their just being young, having a lot of money and not having a lot of oversight. There's a lot of risk for some of the things that you talk about, the Jake Peavy stories, the Kevin Garnett's, those big numbers in the world. But I actually am more concerned about the things that happen that nobody ever finds out of, and things like that. And so to your point, I mean, there are so many things, and we can get into a little bit deeper the difference between, say, an investment advisor and a broker, and the different ways that they're the standard that they have to work by. But there are conflicts of interest that come apart as doing your job that a regular person who's investing isn't going to particularly understand. Some examples that I've seen with clients of mine where it is on the minor side. It's no Ponzi scheme, it's no fraud, it's nothing really terrible, but it's conflicts that these people have to understand. And for example, there's been, with the rise in interest rates, money market funds are now making more money for investors. But brokerages, so your Merrill Lynch's, your Goldman Sachs's of the world, those big firms, what's happening is they're keeping a lot of client money in what are called bank deposit programs. And those things earn very, very little amounts of interest, so 0.05%. Whereas if you're in a money market fund now, you can be making 2 to 3%. But what happens is that these big brokerages, they are incentivized themselves to have their clients in the bank deposit program earning this little bit, because then they can take your money and put that into the money market fund for themselves and make that spread between the difference in interest rates. Now it's not a huge deal, but the problem is when you're talking with athletes, some athletes can have $1 million, $3 million, in the case of one of the clients that I've had, multiple millions of dollars that is in this bank deposit program. And so that is, and as interest rates are continuing to rise, it becomes an issue. And it's something that they don't understand. For one part, they'll see on their account statement, oh, well, I'm in a bank deposit program. So it seems fine. I'm making a little bit of money, but it doesn't seem like anyone else is making a lot of money on money markets and stuff, but they just don't know. And so there's those kind of conflicts that can come up, and there's so many other examples of that happen at bigger brokerages where those firms are incentivized to do certain things that aren't exactly in your best interest that I can let the client know.
Yeah, just to clarify, to make sure that our audience understands and that I'm understanding it correctly, is what you're saying is a lot of these bigger institutions, your Merrill Lynch's, your Morgan Stanley's, your Wells Fargo's, if they have banking capabilities, it's in their best interest to be able to keep that money in the deposits so that they can actually take that and be able to lend, at some multiple out. And so here you are as a client, not really realizing that something that they're selling to you is a benefit of, hey, we're Merrill Lynch, we have Bank of America, this is the world's greatest thing for you. It can actually, doesn't mean everybody is, but it can create a conflict of interest of, well, actually your money should be, in a money market fund, or very candidly, or, whatever, a bond fund or something like that, that's maintaining that interest rate, that we see instead of the small deposits that you're getting. Is that correct?
Yeah, exactly. And I think it's just kind of a small example. I'll give you sort of another example of these smaller things that can come up. Yeah. One client that I had, similar situation where he was at a bigger brokerage house, and he has some private investments, and it's a very small portion of his total allocation. He has a lot of money. He's very wealthy. And so he has the ability to take a little bit extra risk for potentially some more return. But when I started digging into these private investments, one thing that I found was interesting. He was in a handful of different ones, but all of them, the brokerage firm, the Merrill Lynch or the Goldman or what have you, they were acting as selling agents for these private investments. And so what I told my client was, what you need to understand here with these private investments is that your broker is basically bringing these investments to you because his firm is selling them on behalf of this private investment firm. And so that incentivizes the financial advisor and his firm to sell these products to you. So when you're thinking about things, if they're in your best interest, I ask him that, does it sound like this is in your best interest? And he says, well, no, because it's something that the firm is incentivized. And so one thing that I try to clear up with a lot of my clients is just saying, look, I want to make sure that what's going on with you is in your best interest. And when these conflicts can occur, the problem is it's an incentivization for these firms and the financial advisors to sell this product to you, but it might not be the best performing product. And in one interesting case with this specific one, the one private investment was, it was some certain name, and I won't get into the specific name, but it was interesting because it actually was a private fund owned by the brokerage firm, but it was under a completely different name. And you wouldn't be able to find out that it was actually owned by them until you looked in all the filing documents and saw that they were behind it. And so it was very interesting. It was almost like a masked private investment product owned by the firm. And again, these are just conflicts that as an investor, if it was myself, I would say that this doesn't seem like this is being brought to me in my best interest.
Yeah, no, totally. And I think the private investment side is one of the most dangerous and easiest to hide these conflicts, right? It's something for us as, the registered investment advisory firm, being a fiduciary, we've been very careful on helping clients think through alternative investments because as you start to peel back the layers and see how the fee structures are aligned, that's where you can actually see is a lot of times you as the end investor aren't going to make money, or even if the big potential, you've got to look at the management fees. You got to look at who's being incentivized to bring these deals to you. And it's a really scary thing because it's actually when we're in the marketplace, it's one of the things that the big brokerage companies are actually heavily selling to athletes is, you know, because of our size, we have access to these private investments, and it can sound really good. But what I've realized in being connected into the true VC world, with the big, you know, successful venture capital funds, is the best deals are not coming through the big wirehouses, right? They're private, direct access through these VC funds. And so I think that's really important for our audience to know that.
Yeah, and I think we could do a whole podcast just on fees and how that's structured and how people just get absolutely gouged without the real knowledge of what exactly am I paying for this? Because private investments, as a great example, it's really difficult to not only understand all the fees that are associated, but even understand your returns. Yes. Because they're providing you these, you know, what's called internal rate of return figures, IRR. Those aren't even exact return figures for you. It's kind of a way for them, and there's been a ton of stuff in the news about how that stuff and those returns can get massaged a little to make it look better than it is. And so I think there's so many issues with fees, particularly with the big brokerage houses. Many times, not to get too complicated, but they'll invest in funds of funds. And so you have fees on top of fees. And it just is, it's an unbelievably complicated world. And I tell a lot of my clients, you know, finance is complicated for a reason, because people make money from things being complicated and being able to tell you, okay, this isn't that complicated, but you just don't understand.
Yeah. And I think we have a shared background actually coming from the big brokerage houses, right? You mentioned that you had worked for Merrill Lynch. I had cut my teeth at the other big name on Wall Street. And the one thing I want to make clear to our audience is, you know, I think there are a lot of really well-intentioned, good people that work for these companies, right? It's more the subconscious, you know, conflicts of interest of how I'm compensated and also how I'm trained, you know? And, you know, I think that for the athlete and the investor and people listening in it's really hard to navigate our space. The last estimate I saw that there's over 300,000 people using the term financial advisor. And so here you are as a consumer, putting yourself out there, making the first great step of recognizing I need help because this is not my expertise. So how do you sift through these 300,000 advisors? You're talking about, I hear you say, doing what's in your best interest of the client. Can you talk about how you know if somebody is going to do what's in the best interest of you from maybe as an individual advisor and then from a company standpoint? Can you address that?
Sure. So one thing I talk about with clients is there's a difference between what's called a broker and an investment advisor. And they both can call themselves financial advisors. It's just kind of a more technical term of the standard that they have to act behind. And so brokers are typically at your bigger brokerages firms like your Merrill Lynch's and what have you, and they have to operate under what's called the suitability standard. And that basically just means that what they're recommending to you is suitable for you. It doesn't have to be the best possible product, but just that it is suitable for what you're looking for. And then there's investment advisors, and investment advisors are under a higher standard, which is called the fiduciary standard. And the fiduciary standard basically says that the investment advisor has to act in the best interest of the client at all times. And so they're two different standards. Obviously, one is higher than the other one. It can get even more complicated because there's what, as you know, called a duly registered investment advisor. And sorry if it's getting like way over everyone's head, but what a duly registered investment advisor is they can act as both a broker and an investment advisor, and they can kind of wear the hat at whatever time is necessary or adequate or what have you. And so it's even kind of harder for a customer to understand, are you acting as a broker in this situation or are you acting as an investment advisor? And so what I talk to clients about is I say there's also what are called registered investment advisors, which I believe you guys are, where they have no affiliation with a brokerage business or the accounts and do things solely under the fiduciary standard. And what I say with my oversight and my help with these clients as they're looking for financial advisors or they already have them, to start at that level to me is really important, because it makes your advisor hold himself or herself to a very high standard. It has me as kind of as a backstop, saying, asking questions, seeing what's going on, and just making sure everything is in the best interest. And to your point earlier, I absolutely would say that there's tons of advisors who are brokers, who are good people, who are, have every well intention of treating their client in the best possible way. It's just that the incentivization that these brokerage houses have and the products that these guys have to sell, it creates a conflict. And that doesn't mean that the advisor is a bad person. It doesn't mean the advisor is a bad advisor, but it just means that from the client's standpoint, it can be conflicted.
Yeah, I think that's powerful, right? Because I know when I started at one of the big Wall Street firms, I had no idea what this word fiduciary meant, right? But I knew what it was like to be there in a weekly meeting of being suggested on what things I should be recommending to clients. And hey, if you sell them a mortgage, you're going to get compensated. If you sell them, XYZ, they need it anyways. They should just do it with us. And it's one of those things that it's never positioned as you're trying to hurt the client, right? It's just, hey, the client needs this and you have a chance to make some money off of it. And so I lived that for a few years, right? And then I lived the life of the dual registered person of we can say that we're a fiduciary as a registered investment advisor, but then we were attached to a broker dealer. And, we made that final jump a couple of years ago of just saying, if we want to be a true fiduciary, we've got to hold ourselves out to that standard where our clients aren't having to guess which hat am I wearing today. And so just to clarify, is what for our audience and for our athletes, I mean, the big distinction is between broker and investment advisor. How can I tell if somebody's a broker, right? Like, what would I see on their business card? What would I see on their website? Where can I go to see, is Eric Averill a broker or is he an investment advisor?
Yeah, the best way that I point people to is to go onto BrokerCheck, which is FINRA's website that you can type in any advisor's name, any firm's name, and get their information. And what will happen is you type your advisor's name in, and it's brokercheck.org, I believe. And you type that in, you then put the financial advisor's name in. Once you press enter, it's going to come up. And then once you click on that advisor's name, it'll say if this person's a broker, an investment advisor, or both. And so you can get a feel just right there to see whether that person, in what capacity they're acting. And there's also, the SEC has a site that's kind of linked with BrokerCheck as well. That's the SEC, I think it's called the Investment Advisor Public Disclosure website. And that one also is very clear. And you type in the advisor's name, and again, it'll say, is this person a broker? Is this person an investment advisor? Are they both? Are they just one? And you can get an understanding just right then and there.
Yeah, I think that's super helpful. And for the audience listening, we'll put all of this in the show notes. Another way that I thought was really helpful, or just to know quickly, is on the back of a business card, or you just go to their website, and you look at the bottom of this disclosure. If it says anything about being a registered representative, or it will say broker dealer on there, is those words right away will let you know that, hey, there might be some conflicts there. And so I think, David, what you said of a good starting point, right, is it's the funnel and the siphoning of, okay, we've got 300,000 people using the word financial advisor. How do I actually already start at least now making the foundation this group of advisors I know have to do what's in my best interest. Like, that's actually the starting point that I think most people think they're starting at the 300,000. So getting it there is key. From there, what do you do? You know, what are your thoughts about advanced designations? You know, of just, let's say you get it down for 300,000 down to 100,000. What's the next funnel?
Yeah, I think that's a good point. The advanced designations, that does help sort of you know, bring that funnel even tighter and find those people that are even more qualified. I think there's the main designation that's most beneficial and one of the best ones to have in the industry is the CFP, which is the Certified Financial Planner designation. I think that one is kind of the top dog, so to speak, of the industry, and it really does show commitment to education, to being knowledgeable about what you're providing for your clients. And there's a standard of care as well, as once you are a certified financial planner, that you have to more or less adhere to. And I believe you guys have to certify to that. And that's important for me because I think it does show just a sense of really going out there and getting the best designations for the clients. You know, for example, I'm a certified fraud examiner, and that to me was something that I had to have, because how do you, in a world of, you know, in your case, 300,000, bring it down to say, okay, well, I have these designations that show that I have an ability that can kind of further myself and kind of separate myself from the pack. And so I think that one's really important. The CFA, the Chartered Financial Analyst, that's a very, very difficult, time-intensive test. It's 3 different tests. It takes years to get done usually. And that just shows to me a really intelligent person, somebody who understands the nuts and bolts of finance, of stocks, bonds, the whole market. I think that's also a plus. But from a financial planning standpoint, I think the CFP is the gold standard.
Yeah. And I think it's, you know, I myself hold the CFP. You know, one of my other business partners holds the CFP. And what we always say is, you know, it by no means, you know, guarantees you that you're getting the absolute best, but once again, it's that level of standard and care that, you know, I think the latest number I saw was there's over 80,000 certified financial planners. And so my whole thing is there's a vast array of options, relationships, and services within that CFP model. It's just, if you're choosing to work with a financial advisor who isn't a CFP, it's like buyer beware, right? Like, why risk your financial situation when there's 80,000 really good CFPs out there? So if you're working with an advisor who doesn't have a CFP, it's, you know, it's a big buyer beware, you know, from our standpoint. One thing that you mentioned that I thought was great is, even for yourself, as we've jumped into you sharing some stories, but you've got this unique background besides, you know, working at Merrill Lynch as a financial advisor with a team that managed over $600 million. I mean, you spent time as an actual financial regulator at FINRA. And so this is not theory for you, right? You've actually been in these proceedings. You've been in these cases where real money has been assessed in fines. People have been barred. You know, can you talk about, you know, your experience at FINRA? You know, how much money was awarded? Tell us a little bit about that.
Yeah, the reason I really started Bright Lights, I think, was backed on my experience at FINRA as a financial regulator. And I spent over 7 years at FINRA. I had said earlier that I was at Merrill for almost 4 years, and then I moved to FINRA. And that was just an unbelievable experience because, again, when I started at Merrill, I didn't really know what a compliance department was. When I started at FINRA, I didn't even really know exactly how the regulatory world worked. And one reason that I started at FINRA was because of the market collapse. And I was at Merrill when that happened back in 2008. And it was a very affecting time. And we had clients who had lost half their money. They were asking me, what am I supposed to do with my life? I'm 75 years old. And it affected me. I was in my mid-20s at the time, and I didn't have an answer for them. And so you started to hear the stories of everything that went on. The Big Short, one of my favorite books, detailed all that, and just how bad it really was, and the terrible conduct that was going on, the salesmanship. That got me into regulation. And when I started working at FINRA, I just was absolutely blown away by how bad, and I was in South Florida, which I tell most people is probably, other than maybe Long Island, New York, was the worst area of fraud in all of the country for FINRA. And the cases we saw, the people we dealt with, we were right near Miami, so there was tons of money laundering going on through financial firms down there. It just was a cesspool of craziness, and I got to see that firsthand. And so I started investigating all sorts of different things: penny stock fraud, elder abuse, money laundering through financial firms, like I mentioned. And I really started to understand the process of not only investigating, but seeing these things through. Because as an investigator, what we had to do is we would go to a firm, they would be risk ranked based on what was going on or what we thought was going on. Sometimes we'd end up finding the stuff. You would build a case by gathering evidence and books and records that the firm has. And then if it was a serious violation, which, in my time when I was working there, I had a number of really kind of high profile cases. You would then have depositions where you'd bring people in, you talk to them, you put evidence in front of them, there'd be a court reporter there, everything would be transcribed. Then you would potentially go to a hearing or a trial where then I've had to testify a couple times. And it just was this amazing experience from being an investigator, looking at things all the way through to seeing kind of the case complete. And that experience was just amazing for me. And I think, to your point, I joke with a lot of people in the industry. I think I'm the only person in the sports industry that I know who is a former financial regulator.
Yeah, it's usually not the normal career path, that's for sure. And I had read on your website, you were involved in cases that resulted in over $30 million in fines. And so this is, I think for the athlete, you have such a unique skill set to be able to come in, and give a independent, fresh pair of eyes that, you're not trying to manage their investments. You're not, sharing referral fees with anybody. You truly have become the solution to that checks and balances, in conversations we've had with clients and with agents and with other people in the industry. One of the questions that they always ask us is, because we believe very much one of the most important things for a professional athlete is advanced tax planning and expertise. And so for us is we actually have CPAs that work for our firm, and people will ask us, well, don't I want to have a CPA outside for checks and balances? And we've written extensively about this. As I said, that's good in theory, but what you're talking about is actually not a tax CPA. You're talking about an auditing firm or a third party who's going to be able to actually look into your financial transactions or your accounts and make sure things are clarified. And so we say this in the book that we've written is, by all means, we actually think it's really prudent to hire somebody like David to come in, whether it's on a regular basis or once every few years, and check things. And I think you're the missing link that isn't there. For us, we take compliance really heavily. Is for us, we offer bill pay to our clients, right? We do have CPAs in-house. And so one of the things that we provide to all of our clients is we have a surprise audit that we do every year, right? We don't know when they're showing up. It's usually at the worst time. Last year, my wife was giving birth to our second child. It was literally, I think it was like December 29th, and they showed up. And so it's one of those things, they start digging in. And I think having people like you to do that is really important. Can you talk about just your relationship with agents, because it's been really cool. You've had two pretty high profile agencies, especially Rep One on the football side. They represent Ben Roethlisberger, Carson Wentz, Jared Goff, these type of guys. What are the relationships you have with sports agents?
Yeah, I think, and I'm going to remark on something you were saying earlier before I answer that. Yeah. I think to your point about transparency from a financial advisor standpoint, really from anybody that you work with standpoint, to be transparent is so important. And I tell clients that all the time. If people that you work with do not want to be transparent, why? Why don't you want to be transparent? It doesn't make sense to me, because you should be able and be comfortable with the advice that you're giving, no matter what it is, for another person who's qualified to look over that, and just to make sure that for the client, because this is what it's all about. It's for the athletes, for the client, to make sure that he's good. And so I usually for most financial advisors I work with, we have great relationships because they're similar to what you're saying. They're transparent with what they want to do. They get what I'm doing, and they see the value in it. Yeah. Now, as for agents, what kind of happened when I started this business was I got connected with a couple agents, and as you mentioned, I have partnerships with Vanguard Sports and Rep One, and those guys who lead those agencies understood that they had kind of a responsibility to help their clients out from the financial side, because they had no real knowledge of what was going on. The agents help, obviously, with the endorsements, with the contracts. They know how much money they're making because they're helping them with their contracts. But once the money gets moved to a financial advisor and then he or she is managing that money, most agents don't, at that point, they don't know what's going on that side. And many agents also understand the level of understanding and or oversight that their clients are doing with their investments, with their banking. And so with these agencies that I'm working with now, they said, I think this would be a great thing to have for our clients, to have them get some oversight just to make sure everything is going on as it should be. And, in some other cases where it's one-off things with other people I work with, sometimes what happens is red flags or some suspicious activity or questions people have may come up, and they just say, I heard, this about my investment that I have, and I just have a little help from you would be super appreciated. But from the agent standpoint, I think it's a really great thing that they saw that they could help their players with, and not only during their careers. I think with these deep dives that I do, as well as the monitoring, it's going to help everybody get set up for their retirement, because being financially sound and knowing that you're good going into your retirement is not only going to help you on the field, on the pitch, on the diamond, but it's going to help you mentally.
Yeah. And I think from an agent standpoint, I literally, prior to this podcast, just left a meeting with a sports agent who's been in the business for 20 plus years. And they shared the concerns from an agency standpoint that, right now, without somebody like you, it's almost a lose-lose situation, because part of the approach is I'm just going to bury my head in the sand. I don't want anything to do with the players' finances, because it's already really hard to get clients. And the last thing I want to do is be fired because your investment advisor has fraud, or just honestly, you're just not happy with investment returns, or XYZ. Is I don't want to risk that relationship. And it's kind of, I throw my hands up in the air and go, that's not my world. I'm going to stay separate. But then you've got agencies on the other complete side of it that go, I'm going to be so hands-on and controlled. We're going to do it in-house, and yet both of those are really wrong. I love your article that you wrote. I think essentially it was like why good agencies should hire you, recruitment and client retention. And I think it's so true is you're finally now a solution to agents that they can legitimately say to a client, we're not going to push you in any one direction on your financial side, but we have a resource that's going to help you sift through who can you trust, and to have an ongoing lens of that checks and balance by a financial expert, not by a sports agent, who very candidly, they're not paying that person to look over their finances. They're paying that agent to be the best contract negotiator. And so I think you're a really good solution for agencies that they should take a serious look at partnering with you.
Yeah, I appreciate that. And I think on those two ends that you spoke about, where both ends lie, is there's conflicts on both sides. And the problem is, an agent doesn't want to get conflicted in the financial management of his player on one side, and on the other side, they're very conflicted already because they're providing that. And so, I'm in the middle, and I think what I tell a lot of people is I try to have as minimal conflicts of interest as possible to provide as much of a third-party advice as I can for the athlete. And I think the agencies who are seeing that and understanding that, at least in the beginning, they're just are forward thinking, and they understand how that's going to work out for them, and that it is going to bring clients and it's going to keep clients happy. And so it's kind of a win-win situation for everybody, and it's been great to see.
Yeah, that's great. Staying on the agent conversation, I want to ask your opinion on the agencies that choose to do the money in-house. And we're seeing this played out two different ways. Is there are certain agents that they are actually overseeing the investments that are going on. And then there's the second course of, in the baseball agency world, there is one particular agency that it's very well known that they have their own, management consultant entity that, while they don't handle the investments, they actually pitch themselves as kind of your watchdog, that we'll do your taxes, we'll pay your bills, and we'll take care of your travel arrangements, and we'll actually oversee, the people that invest your money. That company is owned by the agent. What are your thoughts around that? Can you dispel what are the conflicts of interest in that type of setup?
Yeah, when all money gets and all kind of business gets entwined with one entity or a number of entities that are owned by the same parent, so to speak, the risk level just becomes very high. And so what I ask in clients where that may be the situation is I say, look, because of this situation and the conflicts that present themselves in your situation where you were talking about, I mean, if something goes wrong, but the people that are doing something wrong are the ones who own your company, I mean, how is that going to get resolved? What's going to happen? What's the conversation going to be? As a client, I would be concerned about that, because having the watchdog being owned by the one who's doing the activity, it just raises the risk significantly. And where I say, where I come in those situations, I say, when you're in a situation like that, you have to have somebody else overseeing what's going on, because the risk is just too high. There's no way that if you don't have the time to do this, if you don't have the understanding to do this, you can't trust somebody who's going to be overseeing you, who's paid by that person. It just doesn't work out. And we've seen that time and time again over the history of finance, that you hope that they're doing a good job, and until I actually see under the covers, I don't know. But it's just too much risk to deal with and not oversee yourself, or have a third party like myself to do that. It makes me uncomfortable, and I think it just presents a lot of conflicts that aren't mitigated by those firms. Yeah.
The other area that we're seeing a lot of in this space is business managers, right? Bill pay is a real service and a need for a lot of athletes as they're moving around. They maintain multiple residencies. As I mentioned, it's something that we've taken on as a firm. We have actual CPAs that are doing it. One of the unique things about us is we sit under at the SEC, so there is massive oversight over us. We have an independent third party that comes in and checks this. But business managers, we most recently saw Mark Anthony lose amount of money from one of the big business managers. What are your thoughts around business managers, specifically for, I would say, Major League Baseball players, NFL players? We're not talking about entertainers or musicians or someone like that. What are your thoughts about them? Kind of a few questions. Is there any oversight? Are they under FINRA or the SEC? And then if you do hire a business manager, how do you watchdog them?
Yeah, so on the first question, there's no oversight of business managers, none. So they can do what they want. There's nobody overseeing what they're doing, and so that itself is a risk. The second thing on just, are business managers necessary for athletes? The question that I have usually with business managers is, okay, what is it that you're going to provide an athlete that he's not either being provided by the agency or by his financial advisors? And typically the answer to that is pretty bad. I've heard, well, we can help with relocation. And I'll say, well, the agency helps with relocation. Well, we can help them buy a car. Sometimes financial advisors and or the agencies have connections to help you out with buying a car. And so it's a lot of stuff that they say that they can do. And the question is, where is the value? And I think that there is value for some people who are in kind of the much higher stratosphere of earnings in professional sports. But what I've seen and firsthand just recently is business managers selling themselves to, or their services to individuals who are rookies, who aren't making a ton of money, whose financial situations, their bill pay, I mean, it's 6 or 7 bills that are on automatic bill pay. They just bought one car. They don't have a mortgage. They're on their rookie contract. They're not planning on moving. And so it's really, what is the value that you're providing? And then it all comes back to, as we talked to earlier, fees. What are you charging? The thing that's amazed me most about business managers is what they've gotten away with charging. And some business managers charge 2% of gross contract. Which if you think of financial advisors, they're charging assets under management fees, but gross contract is basically, it's double that fee. And so it just is, they're huge numbers that they're charging. And in many situations, the value just isn't there. And so it's something I think that athletes need to really consider and look into. What is the value that these men and women are providing us? And is it worth what we're paying? Because I've seen many times where it's just not.
Yeah, no, that's helpful. Sticking on that conversation of fees, just to clarify, is I think that's one of the biggest things I see with business managers, or I'd mention, one of the high profile agencies in the baseball world, they're charging a percentage to negotiate the contract, but then their financial entity is charging another percentage on top of their contract. Is, in my opinion, and we're very outspoken about it, I think it's outrageous that athletes are paying percentages of their gross contracts for financial services, because no wealthy individual would ever do that who's not an athlete, right? It's just asinine. But as far as reasonable fees, if they are sitting here and they've said, all right, we've gotten through the big filter, we cut it down from $300,000. We've actually hired someone who's held to the fiduciary standard. So we've knocked out brokers. We've now hired a certified financial planner. What range of fees are in there? And then what are kind of some things I need to pay attention to on the fees?
Yeah, it's an interesting question. I actually was just watching a YouTube video. I don't know if you know who Josh Brown is of Red Holtz Wealth Management.
Yeah.
He's very outspoken on a lot of kind of issues in the financial advisory world. And so he had a recent YouTube video on just fees in general and where they are going to be going in the future, or at least in his view. And he does think, gross fees are kind of ridiculous. I think that, like you said, it's kind of unconscionable to think that 2% of your gross contract should be paid to somebody just for paying bills and helping you out here and there. I just, the value just with the numbers is not there. And the fact that it's really only offered to athletes gives you kind of an indication that it's nobody else is going to be paying for that. And so that is a problem. But I think from an advisory standpoint, you know, I've seen a mix. I mean, I think my personal opinion is 1% and lower should be the starting point. I really just, I don't think anything above percent is worthwhile. I don't think that the advice being provided is worth that much when we're talking about millions of dollars in assets under management. And you see much higher fees than that. And we were talking about kind of private investments and just fees in general. There's a lot of stuff that individuals are paying that they don't really know that they're paying. And so that adds up too. And that should be included, but in many times it's out of sight, out of mind. And so my opinion is the best financial advisors are going to be at most 1%, probably less depending on assets. I think the more you get, obviously you're coming down a bit. But then also you're being very, very conscientious about what are the other fees that my clients are paying, because that is an important piece as well. There's so many studies on the return over the long term and how fees are one of the number one most important things to just make sure you're aware of, because they eat away at your returns and particularly your compound returns.
Yeah, no, I think that's great. It's one of the things that are, once again, it's very difficult for clients to know. We had a great research paper that was actually put out by Dimensional Fund Advisors, DFA, on the true cost of a fund, right? Is unfortunately, it's not even as simple as looking at an expense ratio, because there's, you know, in an index fund, there's reconstitution fees and trading fees and all these things. But I think it's at least a good starting place to go. You know, if you're in high active management mutual funds and you've got these high expense ratios, those are fees that you don't really know are eating away from you, that are just destroying your returns, you know. And then on that scale of fees, right, I think I'd read on your article, you're generally seeing anywhere between whatever, you know, lower than 1% up to 2%. And I agree with you. Is your assets start to grow, we're constantly asking internally at our firm is how do we continue to justify our fees and provide value, right? And anybody who's selling, especially purely investment management, you know, and they're trying to sell you on, we can get you better returns. When you start to look at the studies, you see that means they're probably an active manager. They're picking individual stocks, or they're picking highly active funds with tons of costs in them. By the time you go through all of that, you've probably got worse returns. You've paid more fees, and it's a really negative standpoint, right? Like, and when we sit down and talk to clients, there's in the publicly traded markets, there's kind of like really one way to invest: low cost, right? Globally diversified portfolios with low turnover, right? Like, That's what you should be looking for. And then the justification for the rest of our value has to become in additional services. Do they actually do financial planning? Are they doing retirement planning? Do you help assist on, you know, P&C insurance and oversight of estate planning? And for us, a big value is the tax planning, you know, and a firm like us, we include the preparation of all of their tax returns and things like that. And so I agree, as you start to evaluate, you know, opportunities, you got to compare what am I paying for and what is the value that I'm getting. And I think it's really critical that people ask those questions.
Yeah, absolutely. I think you hit it on the head. And I think it's those additional services that financial advisors provide, because sometimes people will ask me, do I even need a financial advisor? And my question usually is back, what do you know? Or would you be able to do all of this on your own? And typically the answer is going to be no. And then particularly, you know, with young athletes, a lot of times you just don't have the time to do this. And so you need somebody to help you. And then it's from that point, it's okay, what value are they going to add on top of just choosing investments? Because like you said, the math is very clear. The majority of your portfolio should be low cost index funds with low turnovers, so you're not taking a bunch of tax hits. And so I think that's really important for the athletes to know. And then just on my side, when I got into this business, I was kind of thinking the same thing as to, well, how do I charge? What do I do? And so to differentiate myself to a degree, I just charge hourly for my services. And so it doesn't matter how much money you have to get help. That's not going to be part of the conversation. It's just, this is what my rate is. This is how long this would probably take. And so by just doing the math, this is the fee that it'll be.
Yeah, no, that's great. And kind of standing on, we've covered a lot, and to be sensitive of time, I think you and I could geek out on this conversation and spend hours talking about it, right? But
yeah.
For our audience, I think hopefully our audience has taken away a few things. First and foremost, there's resources out there to help them, right? Your firm specifically can help them navigate this world, whether they already have a financial advisor. Maybe they're a potential draft pick. Maybe it's an athlete that's expecting a big contract to come in. Where can athletes actually work with you? Can they come at any point in their career? I don't know whether it's just contacting you for more information on your fee structure, but if someone in the audience wants to work with you or is intrigued, what's the next step?
Yeah, on the first question, really I can run the whole gamut. My services provide from sort of the start of an athlete's career to the end, and really even past that, because the monitoring for me is really important, I think, for athletes who need some additional oversight over what's going on. And when you retire, if you have a significant portion of money, that's going to be definitely a point of concern. But even on the beginning, I'm working with a client right now who is a rookie in the NBA, and I helped him and am continuing to help him find a financial advisor who's going to work in his best interest. But then after that, look over what's going on, because it's a young guy and his experience in finance is very limited. And so I'm there to help him as kind of that third party, walk him through this whole step. And again, it goes to what we talked about. I'm trying to get him started at the best possible point with a fiduciary, somebody with reasonable fees, who understands the right investment philosophy, who doesn't have conflicts of interest in the way he's going to provide investments. And that sets him at a really good start, because in a lot of cases, many people start on a completely different foot. But then after that, I'm going to be there with him, monitoring what's going on. Any questions he has, he can come to me. And so really can go the whole gamut, from the start, from the middle, if you want kind of a deep dive audit into what's been going on, all the way to the end. And so I think it's really important. From what I've seen just in the time that I've been around, the value of what I can provide is significant, because we're talking tens of millions of dollars in cases, and in some cases some really bad stuff is going on. And so it is a risk that everybody needs to acknowledge. Everyone's at different risk levels when I look at them, and can kind of go through them, and that's what we sort of talk about. But in terms of contacting me, the best ways are, my Twitter handle is @Lights LLC. My email is on my website, my website is brightlightsllc.com. And then my personal email is david@brightlightsllc.com. And so any of those ways to contact me, you're more than welcome. Or if you just have a question, anything at all, I'm just happy to help.
Yeah, that's great. Thanks for sharing that. And for the audience, I'm going to put all of this information in the show notes. I highly encourage you to follow David on Twitter, or go to his blog, because David, it's been super valuable, the resources that you've provided. And David has a tab on his website called Resources that has everything from links to financial literacy to the actual regulation institutions that you can go and check out who the advisors are, and just a lot of educational information. And so it's one of those things that I cannot, emphasize enough, that you as a professional athlete, you are the owner of your own company. This is your career, and very much like a pitcher, you've got a lot of teammates around, but at the end of the day, the W or the L, the win or the loss, goes next to your name. And this is a high stakes game, right? This is your family's financial future and for the rest of the life. And so I really implore you to take that ownership of your career. Call David. I know for a fact that he will entertain a 15-minute free consultation call with everybody to kind of know your situation. And so I'll make sure David's contact information is in there. I'm planning on working with David to make sure that we can get his free resources distributed out to everybody that's subscribed to the podcast. And so, David, thank you so much for your time. Any final words that you want to share with the audience?
No, nothing really. I really appreciate the time. I really appreciate you bringing me on. It means a lot that you give me this platform just to talk to everybody and to your clients and what have you. So I really appreciate it.
Great. Well, audience, thank you guys again for your attention. We wish you the best of luck in your career. For those listening in that are into playoffs, we wish you and your team the most success to the World Series. And if you guys really enjoyed this show, please head over to iTunes, leave your comments, your reviews. If you have questions, reach out to me. As always, you can go to athleteceo.com and drop your email in there, or shoot me an email at Eric@athleteceo.com. And we look forward to seeing you next week with another world-class interview on the Athlete CEO podcast.